Great, good evening. Is this on?
Yes.
All right. I wanted to review where we are and how we got here today. As you see on the screen, that's our sessions. At the beginning, we had the session that I had on, sort of the overview of new ventures. And the big things that you should have taken out of that was there are only two real things you need to do. One is to figure out how to create value. And the second is try to figure out how to capture some of that value so you can do it again. And then Bob Jones came in starting down the process of how do you figure that out by talking about finding your customer. And there he was asking, for whom do we create value? How much value do we create? And how big is how many people value that value? And then the second night, we had Rich Kibble come in to talk about business models. So the idea is you've got a customer, and you think you have their interests. How are you going to do the second part of what I said on the first night? How are you going to capture some of that value? So the business model says how you're going to translate your activities into something which you can do again, be it profit or a way of sustaining the venture. And then Joost came in after Rich Kibble and talked about people, focusing on MIT startups, but people being the key part of how you make all of the other parts work. And he gave us some good examples of things that worked and things that didn't work, and I hope you got something out of those unique stories that he did. And then on Thursday, that would be the third session. I was not here for that one, but hopefully you enjoyed Mindy and Vicky's session on negotiation skills, because you're always sort of negotiating with all the people you're dealing with at some basis. And then after that, we had Ken Zolot giving you sort of an inside view of entrepreneurship at MIT from two students who are in the process or have been in the process of it. So we're giving a little bit of the undercover look at that. And then last night, Bob Jones came back and said, all right, now if you got all that other stuff sort of arranged, you need to pitch it to people, everything from customers to employees to partners to eventually perhaps investors. And then I came in and hit you with a fire hose with all things legal in the second part of the evening. Most people staggered out with glazed over eyes, but hopefully the deck will be useful for you. So tonight is financing night. We've got all that other stuff you've been through and you've worked, and now the question is, you think you have a model that works, you think you have your customer, you maybe have identified your team, and then where are you going to get the resources, the financial resources to make it all work? So the first part of the evening, we're going to have a panel on sources of financing and getting different perspectives. And then in the second part, we're going to have Charlie Tillett talking about financial projections. So that's sort of where we are. And then tomorrow night, Yonald Cherry comes in and tells you the inside story of the Virtual Inc. Saga, and it's an unusual to get someone to come in and actually tell you all the good details. That's why he's not going to videotape part of the evening. So with that, I asked our moderator on the financial panels, Julianne Zimmerman, if I could run a little video, which I'll do, and then we'll invite you up. Let's see if I can get this. All right. If I can do this upside down and backwards. Let's go back here. Oh, there we go. A little 3-minute. Do we have the sound?
Yeah.
Most young companies need money, which may or may not come as a big surprise, but they do. The number one source they get money from is from their own savings. Whether it's a few $100s or even thousands of dollars, that's what we tend to tap first. And a lot of companies don't get money from any other place. They get money from their own savings, and then after that, they're lucky enough to be cash flow positive. They're profitable. So we talk a lot as if all companies require all sorts of external capital, and the reality is that more than half of young companies get all their funding from a combination of founder savings and then cash flow from the business, and we're out of here. Next up on the list is another one that catches, I think, people by surprise, and that's credit cards. Almost every young company you can think of, to one degree or another, was funded on credit cards. And it is the single largest source of capital for young companies after founder savings. And then the next place where they tend to get money is from friends and family. After I've tapped out my credit card and I've used up all my savings, I turn to people I know and say, hey, will you help me? And that's the third biggest source of capital. And then the next place is banks. And the banks are a totally weird situation because with banks, they get a lot of attention, but they actually fund very, very few young companies. But it's not their fault. You have to think about the way bank lending works and how shareholders want banks to lend. They want them to lend money against secured assets. And young companies don't have any security. They have nothing to secure it against. And the joke in the industry is you can get all the bank funding you want as a startup as long as you don't need it. And then the last piece is venture capitalists. They get the lion's share of the attention, which in some ways is warranted. You know, your Googles and Apples and FedExes and many others all have venture capital money inside of them. But the reality is, and this is from Kaufman Research, less than 20% of the fastest growing companies in the United States took any venture money. And that's not because the VCs wouldn't give it to them, it's because they didn't want it or didn't need it, because they had all those other sources. I don't need money, and I certainly don't need money on these terms. Because venture capitalists, unlike banks, they don't lend against secured assets. They give you money in exchange for shares. So they take some of your company away. So my answer is if you don't need it, definitely don't get it. There's no question the venture industry has become staid. The irony is it's intended to fund disruption, and yet it's an industry that had become complacent. And interestingly, over the last 5 or 6 years, we've seen the emergence of other mechanisms for funding, like AngelList, like these kinds of peer-to-peer funding sources, as people increasingly provide capital in smaller amounts, but more people doing it directly. Having said all of that, though, venture capitalists are hugely important for those young companies that don't have access to bank money, but are growth companies. They have the prospect of being a $5 million or a $10 million company in a couple of years, and they need that growth capital to get there quickly. So it's a race. And the way you play the race is by getting money from people like venture capitalists who give you the money so you can compete with other people who are racing as fast as you are. If you can run a company off cash flow and some combination of credit card, your own savings, and friends and family, Bob's your uncle. Run. Keep all the equity because, there's no better thing than being in full control of your own destiny.
Well, perhaps our panel will comment on that as we get going. So let me introduce our moderator tonight, Julianne Zimmerman. She started off as a rocket scientist, I believe. Who's that? And then she progressed to almost becoming an astronaut a couple of times. And having looked at those two things, deciding she wanted to take something less risky, so she moved into the entrepreneurship arena. And I'm going to invite her to come up and introduce her panel. Help me welcome Julianne Zimmerman. Let me kill this. You don't need this in the background, right?
Thank you.
You're not going to show anything.
No, I'm not.
All right.
Yep.
Now, if I can-
So, good evening, everybody. I'm an alumna, course 16 and 21, a long time ago. And as Joe said, I had a first career in the manned spaceflight realm, after which I became a co-founder. And I've been quite active in the community here as a mentor and advisor and board member and the like. I co-founded a seed stage venture practice a few years ago, and I'm currently raising a fund to invest at early growth stage. So a variety of perspectives. We have, the goal for this session really is to give you a sense of the options that exist. By the way, can you hear me? Am I standing too far from the mic? Our goal for this session is to give you a sense of the options that exist for funding your startup, whatever that might be. We are not going to be able to touch on all of them by any stretch, but I hope to give you a sense of the range available. And for that, we have a phenomenal panel. Before we introduce the panel, I'd really like to get a sense of who you are. So by show of hands, how many of you are currently starting or in the throes of starting something? Awesome. How many of you intend to start something at the end of the term or conclusion of your studies? Cool. How many of those are for-profit? How many are hybrids or nonprofits? All right. So panel, you have pretty interesting class. Any particular requests you want to call out for things you're hoping we're going to touch on? Anybody? Oh, don't worry, we'll come back to you for questions later. All right, so please, panel, I would love for each of you to just give a brief introduction, each for yourselves. If you haven't already looked at the bios of the panelists, I encourage you to. This is a really, really auspicious panel you have in front of you. And Julia, would you kick us off?
Yeah, sure. Good evening, everybody. My name is Julia Kline. I'm a corporate finance and securities attorney. I work for a firm right across the bridge in Brookline called Cutler Walensky, but I also have my own little side firm called Impetus Law that is really focused on startup company advisory services. And I advise on clients on a variety of matters. Funds, private equity investors, angels, public companies, compliance with the Securities Act, Exchange Act. But before you get to that point, I advise startup entrepreneurs on how to structure their businesses and on their various financing options.
Good evening. My name is Addie Chamberlain. I'm currently a Director of Strategic Partnerships at Mass Design Group, which is a nonprofit architecture firm with headquarters here in Boston and Kigali, Rwanda as well. Before that, I spent 6 years at New Profit, which is also based here in Boston. And it's a venture philanthropy fund, so it's basically like a nonprofit venture capital fund for the nonprofit sector. I went to the Fletcher School prior to that, and prior to that I spent 6 years in private practice immigration law.
Hi, everyone. I'm Lisa Sebesta, and I'm managing partner of Fresh Source Capital. We're based just down the road in Cambridge. We are an investment firm that focuses solely on the food and agriculture space in New England, which also incorporates food tech, really anything related to food. Our fund is, while we are financial investors and that we're looking for the same types of returns that a conventional VC is looking for, we also have very much of a mission-oriented fund in that we have a social mission around rebuilding the food system in New England, which means that we kind of attract a different set of limited partners than probably a traditional venture capital fund would.
Good evening. My name is Payal, Divakaran, and I work at a venture capital firm called 406 Ventures here in Boston. We do early stage Series A investing, so I'm one of those VCs this video talked about. We focus on B2B companies, so anything selling to enterprises with 4 core focus areas. They are healthcare IT, cybersecurity, data and analytics for the enterprise, and then cloud infrastructure. So those are kind of our 4 swimming lanes and where we spend all of our time. So we won't do anything direct to consumer or anything outside of those segments. Typical check size for us is $2 to $6 million in the A, and then reserving a healthy amount of capital so that we can support the companies in their future rounds. 60% of our capital has been deployed in the New England area, but we are a national investor. If I look at my portfolio, I've got half my companies in Boston, but the other half across Nashville, Madison, New York City, LA, and most recently the Bay Area. In my background, I'm a proud MIT alum, course 6-1 and 15. Started my career in tech investment banking. Was there at the height of the crisis at JP Morgan, so that was a lot of fun. And then I went into tech private equity, was investing in many of the same segments, just at a later stage. Went to business school at an institution across the river, I won't name. And there I started a tech company, which was a really pivotal part of my experience. So started a company in the job recruiting software space, went through an accelerator program, raised funding. So have been on the other side as an entrepreneur. Also worked at a tech company in the Bay Area. And then I've been at 406 for a couple years now as a principal, and I do all the investing activity and portfolio management there.
All right. So, Payal, let's start with you.
Great.
Especially since you, I think, took some objection to the video. What would you say are some of the, first of all, the key misconceptions that founders often have when they come to meet with you as a venture capitalist? And what would you say they ought to have in mind? How should they think about venture capital?
Sure. I actually don't disagree with a bulk of the video. If you have the capital or the ability to fund your own startup, that's fantastic. I spent a prior life investing in companies that were bootstrapped up to about $20 million in revenue and were profitable. And you just, as the video said, you get to control your destiny. I think the bit of misconception, or the thing that I would argue against the video, is that we're actually quite helpful. I mean, I think, of course, interview your VCs, but the reason a lot of entrepreneurs take capital from us is because they want to accelerate at a faster pace, and they don't know all the answers, especially if you're a first-time entrepreneur. We are partnering with our companies and helping with everything from hiring to strategy to sessions on every single part of your business, and we're really an extension of the team in helping you to grow faster and better. And so while you do give up equity, the trade-off is you get a lot of expertise. And look, startups are in a valley often a valley of death. And so it's really hard to have companies succeed, and venture capital could help to change that statistic for your company. So that's the part that I disagree with. I think that there is more value from venture capital than the video suggested.
And so what do you look for when you're evaluating a company? What are the hallmarks of a company that would capture your interest?
Yeah. So I typically talk about 10 things, but I won't. I don't think we have time for all of that. But the number one thing that we're focused on is people. At an early stage, it is all about the founding team and the people that you've surrounded yourselves with. Do you have kind of the grit, the knowledge of your segment, and some sort of differentiated capabilities around your team that's going to allow you to succeed in what is a very competitive landscape for startups? The second thing that we're looking for is something called product market fit. Have you built something for the right set of customers, and have you proven that it provides value actually for those customers? And that can be in the form of a handful of customers, it could be in the form of revenue, or it could just be in the form of a really large pipeline. It depends on the sub-segment. And then we're just overall in terms of market, I think some people don't realize we're looking for a really large market size, right? Venture capitalists, we're underwriting to a 10x return, right? So let's say we put in $10 million into a company. We want to be able to get $100 million back. For us to get that much back, you have to be able to become a big enough company. So I think often entrepreneurs come to us and say, this is a $200 million market. Well, that's great, but we're never going to make money in that market, in our model. So you need to be in a multi-billion-dollar market, assuming you can take some sort of meaningful market share of that market for us to make our return. So those are the three that I'll highlight, given the time we have.
Thank you. So, Lisa, a bit less well-known is the area in which you practice. So give us a sense of how your practice works at FreshSource, and how that's a bit different from what Payal and other VCs do.
Sure. So, this, as I mentioned up front, we are a financially focused fund, but with this social mission attached to it as well. And so what that means is often we know that the entrepreneurs we're working with may not want to ultimately sell their business. And so what we do is we use what we call structured exits. So as opposed to us, investing in an equity position, and with the expectation that within some period of time, say 5 to 7 years, that we will return our capital with a sale of the business, or a sale of at least our share of the business. We actually structure it in from the very beginning. We do a lot of what's called, it has a bunch of different names. It can be called a revenue share, it can be called a royalty loan, but essentially an agreement where we capture a set percentage of the company's monthly revenues. And that can be either for a set period of time, or it could be up to a certain value, at which point the obligation has ended. So it's a good fit for a company that may not be on the same exact growth trajectory that some of Payal's companies may be. It could be, but it has, it obviously has to have some growth for us to achieve a return. Because we're taking, we're looking for companies, in order for us to do that kind of loan, companies typically have already, are already cash flowing, or at least at a break-even point where our capital is going to get them to the point where they're cash flowing. So we're taking more risk than a bank would take, but less risk than a traditional venture fund. So we can do that at rates that are probably, or at terms that are kind of in between a bank and what a VC could offer.
And again, what are you looking for in the companies that would attract the attention of your fund?
So because, again, we're looking for companies that are either already cash flowing or at a break-even point, we're typically not looking at really early stage or startup companies for this kind of royalty financing. We're looking for a company that has already gained some traction, probably has 1, 2, 3 years of operating history behind it, and has kind of proven out their business model already.
Thanks. So skipping to Addie, one of the things that anyone who's starting a nonprofit or a hybrid might think about is strategic partnerships, which you've done an enormous amount of. Can you explain how those work, sponsored, particularly in the nonprofit and the hybrid world?
Yeah, absolutely. So at New Profit, the second half of my tenure there, I worked on our partnerships with Deloitte and Bain Capital. And so it was trying to figure out how we can utilize the skills and resources of these great companies, these great institutions, against the particular challenges that New Profit and its portfolio of social entrepreneurs had. So just real quick, New Profit basically raised growth capital, which we then invested in really innovative nonprofits that we were trying to bring to scale. So they weren't startups, they were kind of in growth stage 2. Folks and ideas that had proven that they were having an impact and had a replicable model. And then we kind of would come in and say, okay, how can we take you from impacting 5,000 kids to 500,000 kids? So organizations like Citizen Schools, Teach for America, Europe, things like that. And so we were a nonprofit ourselves, and we were funding other nonprofits. We weren't getting any fiscal return. We were looking for social impact return. And so we had both our own needs within our business, our organization, but then we also had needs of the companies the nonprofits that we were investing in. And so it was an exercise in really understanding what are the needs of these organizations and helping them identify that, which is actually a lot harder than you think it is. And then it's also very difficult to prioritize those things and say, okay, this is what I would love to have versus this is what I would love to have and I needed it yesterday. And this is what I absolutely have to have, or my impact is going to be dramatically downsized. And then figuring out what are those people good at in those partnerships. And that is actually much more difficult than I think a lot of folks anticipated it would be, because when you're in your job, everybody knows what they're doing, but trying to translate that across worlds that don't speak the other's language takes a lot of time and a lot of effort and a lot of conversations and a lot of listening. So it takes a while to set that up and say, okay, where are the best places that we could actually partner and collaborate together? And then how do we apply that in a way that is meaningful and impactful for both parties? Because obviously on the part of a Deloitte, a Bain Capital, any sort of corporate partner that you have, they have different things that they're looking for as a result of that partnership. Obviously there is no financial outcome for them. Certainly directly, I think there is a very strong case to be made that there is an indirect financial outcome. A lot of organizations now are, especially the big ones, are doubling down on who they are as corporate citizens, because they need to actually be able to recruit people to work there. And now millennials are demanding particular things from their employers. So this actually does have a very indirect business benefit, I would argue. And then like taking baby steps over time and growing that out, experiment, fail. Don't be afraid to fail. If something doesn't work, go another direction. And over time, you can kind of build out the repertoire of what makes sense for that particular partner. But a lot of it is built on like listening and talking and being open to experimentation, I would say.
So what, can you give us an example, even if you don't tell us the names, but can you give us an example of what was a particularly effective partnership that resulted in funding a nonprofit or a hybrid?
I would say, well, I guess one example is, so New Profit was actually founded back in 1998 by Vanessa Kirsch, and she tells this great story about how she had this vision for creating an entirely new like capital market, that the nonprofit sector wasn't being serviced the way the for-profit sector was. And she found a couple of people who really believed in what she had to say and how she wanted to do it. And those folks like went all in on their support of her and helped her open a number of doors. And one of those was to get a meeting at the Monitor group. And she went in to this meeting, laid everything out on the table that she wanted to do. She literally had one idea on like 100 different index cards and presented it all, and they literally swept them all off the table and said, we want to do it all. We want to go big. We don't want to dabble. And I think that is kind of on the early side of partners really understanding like what it takes to like lift something off the ground in the nonprofit sector. I would say that is a great example. And then another is we actually used a Bain Capital team at New Profit to help us do financial analysis on nonprofits, which was very difficult and tricky, and it took a long time to really get a robust understanding of building something that worked for what we were interested in seeing, because that's not always the same as what the for-profit sector is interested in seeing. This isn't just about, are you making money, are you not? And so it was a very challenging, lengthy process that I think both teams learned a lot from and came out quite well in the end.
All right. So Julia, last and definitely not least, tell us about, let's start with crowdfunding, because I know you work on a lot of different kinds of funding, but let's start with crowdfunding. Can you help demystify crowdfunding in 3 minutes or less?
Yeah, absolutely. So recognizing this is not a securities law class and no one wants me to summarize the Securities Act, I'm going to really sum it up in literally like 3 or 4 sentences. Okay, so the general rule is, with securities law, is that to offer, sell, or security, it needs to be registered. Okay, and that entails filing a lengthy disclosure document that requires a team of lawyers and accountants to prepare, and generally costs somewhere around the 6-figure range in professional fees. So that is why startup companies cannot afford to register securities generally. So how do we solve this problem? We need to, money is generally foremost on most founders' minds when they go to start their business and finance growth. But as we've already discussed a little bit, and as you saw in the video, it's very difficult. Unless you have a lot of assets to secure a traditional banking loan, or your company is already cash flowing, in which case you might want to talk to a venture capital firm or an investment bank. When you're in the really pre-cash flow stage, how do you get money? You've probably already gone to your friends and your family, and Aunt Betty, and Aunt Betty maybe gave you $10,000, but what do you do after that? Well, one of the ways that Congress came up with the 2012 Jobs Act is the general rule is you have to register a security to sell it. Otherwise, if you sell an unregistered security, the investor has rescission rights, which is basically they have the right to get their money back. Nobody wants that. So the way the Securities Act is structured is that to sell unregistered securities, it has to fit into one of the exceptions. There are a lot of different exceptions, but there's no exception for friends and family. In fact, a lot of people think, well, if I can just, take Aunt Betty's $10,000 and I'll just give her a little piece of the company. No, that's actually not compliant. And Aunt Betty, at one point, might have a right to get her money back if you just sold her an unregistered security. And generally that doesn't happen, but Aunt Betty's ex-husband might get awarded a piece of the equity, right? And Aunt Betty's ex-husband might want his money back. So you don't want to do that. So Congress came up with this new exception to the registration requirement. And it's Section 4A6 of the Securities Act, if anybody cares to look that up. But it's basically allows for equity crowdfunding. Now, everybody's probably heard of Kickstarter and knows that that's been going on for quite some time. That's rewards-based crowdfunding. That's when you donate, you put some money in online into to some crowdfunding campaign that you think sounds pretty cool, and maybe if you're lucky, they send you some like tchotchke or some sort of little thing to thank you for your donation. But you didn't get stock in the company, and you have no right to receive stock in the future. So that's how this is different. Beginning last May 2016. Companies that are private can raise up to $1 million using this crowdfunding exemption. Now, startup entrepreneurs, does that mean you should go, beef up your website to provide, put a PayPal connection on there and start raising money? No, it has to be done through an intermediary. The SEC or FINRA, they decided that the best way to sort of regulate the system is to have gatekeepers. And so you have to do all the crowdfunding through either a FINRA-registered broker-dealer or a FINRA-registered crowdfunding portal, of which there's about, last I checked, about 15. So, and they're not all created the same. Some of them have a focus on certain types of businesses. For example, I know Republic is very much interested in women-founded businesses, and you can go on there and you can see the different types of offerings. There's some other ones that are focused on food and beverage industry, things like that. There's been a lot of successful campaigns with consumer products. Also, there's been a lot of breweries that have been funded to the tune of almost $1 million. But you can actually set your own funding target. And the rest of it, it's kind of similar to rewards-based crowdfunding in that you set a target amount and you go through, of course, all the compliance steps to do the offering. It's a very basic disclosure form called a Form C. You file that with the SEC and you start raising money. And then you have you state your own closing date. It can be anywhere from 21 days to a year, as long as you want. Generally, studies have shown that the biggest funding days are in the first couple days after the offering goes live and in the final 3 or 4 days of the offering. That's when you raise the most amount of money. But it can be a very powerful tool for companies that really need that seed capital that is so difficult to get from the traditional funding sources. But one thing I might add, you can actually start a crowdfund offering, and you can use that in at the same time as other Securities Act exemptions. So for example, if you were to start a crowdfunding offering, and then it generates the publicity for your company or your product, and all of a sudden you get a phone call from an angel investor who says, hey, I love your idea, I want to invest. You can actually take that funding as well at the same time. It's just under a different registration exemption.
All right. So you got all that, right? So let's say I'm in this class and I'm starting a company now, or I'm preparing to start a company at the end of the term. How should I think about seeking capital? What questions should I have in mind, and really what expectations should I have? For example, how long should I imagine it's going to take me to raise capital? And what are the considerations that I should have front of mind as I'm thinking about what kind of capital I should choose for my company? I'm going to throw this out to the panel, and I hope you disagree. Anybody want to go first?
Sure, I can take a crack at that. I guess, first of all, I would say it always takes longer than you think it's going to take. So, I think, people kind of think it's going to take a couple months to raise, I don't know, $500,000. It's a long process. It's even that when you find an investor, whether it be an angel or a firm like ours, that process just takes a long time. The due diligence process takes time. It's the getting to know each other. It's the, okay, this is what we're thinking about how we would invest, and is that consistent with what your expectations are? It's basically like it's a relationship building process, and that takes time. The legal part takes time, just the documentation and the negotiation of terms. All these things take time. So I would say, plan on at least 6 months at a minimum. If you're planning on a significant fundraise that's not from friends and family. And the only other part I'll say before letting other people jump in is that you really want to think long and hard about your first investor, and because that first investment actually has a lot of implications about the money that you raise in the future. As Payal said, that they reserve funds, they do Series A, but they also, you reserve follow-on funds. We do the same, so it's just important to understand who your investors are and what their capacity is to continue to support you, whether it be financially or through other types of expertise. But also, you really want to keep in mind that what you do now has a lot of implications on whether it be in terms of valuations, how much you're giving up. All those things have repercussions down the line, so you have to really think long and hard before you do any of that.
Yeah. And I'll expand on both of those points a little further. So in terms of the timing, the best parallel is that it is like a dating to marriage relationship. So you can choose to date someone a few times before you propose and get married, but that's probably unlikely. And so VCs will want to spend a lot of time with you, get to know you, a la date you. And because what we're getting into in some cases with our companies can be a 10-year partnership. And trust me, it's harder to get out of than marriage legally. So, it's going to be a long, probably bumpy road. Even the companies that go up and to the right, they go up and to the right with squiggly lines up and down. So for that reason, the process does take a long time. If you want it to take less time, as in anything in life, competition helps. So if you've got, the only way we've ever moved faster in the process is when you have other firms at the table, you have other term sheets, you're creating a competitive dynamic, you're a hot deal. Those can get done in a matter of weeks, but typically we're getting to know companies over months. And we like to get to know them early, so even before you need our level of funding, we might know a company for years before you actually take capital from us. And then on the type of funding, so it's typical, as I think we've mentioned before, for a company first starting out to go to kind of friends and families, or what you would call angels. And typically the form of that investment is in something called a convertible note. That's the best way not to hurt yourself for later rounds. So they're typically just investing in what's called a note instrument. It has a certain maturity, but it doesn't value your company. And it converts into the next round when you do get financing at a certain discount. And that's why those early investors get the benefit of that. But the nice thing with that is it doesn't put a value on your company. So when you come to us for Series A, we can value your company and not have to worry about, oh, your prior investor said you're worth $10 million, and so now we've got, can we get there? Are you worth that much or not? And so I think that's what you were talking about a little bit with prior rounds. So convertible note is common. There's something now called a SAFE, which is being used a lot more in what I call Silicon Valley, and it's making its way a little bit over here. The difference is there, it doesn't carry an interest rate like a convertible note does, and it's just not considered debt in the way that a convertible note is legally. And then when you get to your real venture financing, you're doing an equity round, so it's priced. We put a value on your company pre-money. We give you some amount of money, and that's your post-money valuation. And we take ownership for that, right? So our capital divided by your post-money valuation is what we own in the company. And so you are giving up equity, and that's common for your venture financing rounds.
Anybody else?
One thing I might add is, for me, like the next layer question up to is, challenging people to think about, do you really want to start a for-profit versus a B Corp versus a nonprofit? That might sound ridiculous for some, but I think we're seeing a lot more great ideas come out where people really are navigating towards like a hybrid model. And there is a lot of money going in that direction. Like the whole impact investing sphere is gaining by like leaps and bounds, which makes my heart happy. It's slightly outside of my wheelhouse, but there's great organizations out there where you can look into these kinds of things, like GIN, G-I-N-N, Global Impact Investing Network, I think it stands for, like Julianne's organization. There's just like the trajectory of the amount of capital flowing into ideas, products, entities, services that are kind of towing that social benefit and fiscal benefit line is just dramatically increasing by leaps and bounds. And for the few folks that are thinking about like the nonprofit side too, I just can't underscore enough like how important unrestricted philanthropic giving is. I think a lot of people will really try and be like, I want to fund this piece of what you do, and I want to fund that piece, and to have that critical, like key, unrestricted supporter is just, especially in an early stage, is going to allow you a flexibility that can't be underscored enough. And I think it was Payal's point, the initial, or maybe it was you, the initial investor too on the nonprofit hybrid side, I would double down and advocate for is just so critical. I would say that for most really, even more than needing capital at that stage in the nonprofit sector, they really need like the guidance and the advice and that confidant and the someone to, say, this is what I'm going through. I don't know this. And especially like for entrepreneurs, social or regular, it can often be a very lonely experience, and having that like institutional foundational person by your side in that role and not just here's the money, I think is really, really key.
Yeah, so the only thing I would add, I think this has already been mentioned, but it's just really important to carefully consider the potential funding source and investor you may be talking with who's interested in your company. Really consider what realistically their goals are. I know it's difficult because a lot of entrepreneurs, they just need that early stage capital so badly that if somebody is willing to go ahead and cut you a check, it's really, really tempting not, to take the money. But if you are not aligned with that investor's expectation of how much money is going to be required. For example, you think 500,000 sounds like a great number, let's go ahead and take it. In reality, if your company is going to need $2 million to really get the market share, whatever the case may be, then you're going to right off the bat be misaligned your interest, because they're not going to want you to take any other money. You're going to have to take more money, and then we're going to have unhappiness on somebody's part here. So knowing how much money you're going to need, when your investor, when they're expecting their exit from the investment, if they're expecting like a public exit in 12 to 18 months, and you know that your company is not going to be able to grow that fast, that's not going to be a realistic set of terms. So it's just really important to consider. There's there's not one answer that will be right for every company, and every industry is different. But that's all I'd say about that.
That's actually a brilliant segue. I'd really love it if any of you, but particularly Lisa and Payal, would be willing to share an example, and again, you don't have to name names, of a really good investor-founder relationship or investor-startup relationship. What does that look like? How does that relationship unfold, and what does success really look like? And also, if you don't mind, an example of how things go sideways. What does it look like when it doesn't work?
Yeah, so I'll pick an example in my portfolio, a company called Redox, which is based in Madison, Wisconsin, the land of Epic, which is a large electronic health record system. And the team there came out of Epic and started a company around EHR interoperability. So they're helping software applications to be able to connect into EHRs and read and write data, which is actually a lot harder problem to solve than it sounds. So we generally consider a good partnership to be one where we are considered an extension of your team and where we are your first call in good times and in bad times. And so what's made the almost 2-year relationship with Redox so great since we funded their Series A is that there's been a ton of open communication, there's been a lot of trust, and the founders and management team are willing to be coached and listen to us. So there's kind of two-way feedback. And I'll give you a couple examples of how that matters. So I recall getting a call from Luke, the founder and CEO, one evening saying, Payal, we just had an hour of product downtime, and it affected 5 paying customers, and we're in a bad place. And I was the first call for that. And that was really helpful because what I was able to say was we were able to work together to say, okay, let's figure out a 24-hour and then a 48-hour remediation plan. And here's what we typically see with regards to how you deal with your customers, some concessions you can give, how you can comfort them on the viability of your technology since you're an early stage company in this type of situation. And he, 1, called me, 2, was willing to take advice, 3, executed on a plan that we worked on collaboratively, and they got out of that. I mean, that's one nugget. I talk to Luke weekly, so there's so many things, fires we fought together that I could tell you about, but that's an example of a great relationship between an entrepreneur and a VC where you feel comfortable doing that. And it's gone so well. The company continues to grow. They just announced a $9 million Series B round from RRE Ventures, which is a great, well-known firm. It was preemptive, as in they didn't need capital, and they had tons of interest coming in, and they raised their next round at over a 2.5 times step up, which means the value that we invested in at a 2.5 times that. So I just think, when you have these types of partnerships and we're able to help you through both the good times of raising a preemptive round like that, and then bad times of when you have product outages or when you need to fire someone you just hired 2 months ago, or when your customer funnel isn't converting the way that you'd like to. These are all things that we've worked on together. That's when you build a really great relationship and you accelerate a lot faster.
No, I just want to reiterate everything Payal's saying about that relationship part of this, funder and entrepreneur, because it really is key. I mean, I think, it's one of our portfolio companies is Just Add Cooking, which is a meal kit provider based in Boston, and their competitive advantage to Blue Apron, which is one that most people know, is that Just Add Cooking uses local ingredients. They deliver same day, so they don't do the 2-day FedEx, which Blue Apron and some other meal kit providers do, which uses a ton of packaging. They use basically like 1/10 of the packaging that some of the national providers can do. But in order for them to really saturate the Boston market, they needed our help in terms of figuring out where were the best sales channels for them to operate. So, we kind of put our collective heads together and said, okay, if you're looking for this is your target customer, these are the demographics they're looking for. Mostly families with people with young children, to working parents earning at a certain income level. Here are all the places where those people live and work. And so let's figure out both sort of the online and offline sales techniques to get to those people. So whether it be online in terms of Facebook, Instagram, social media, as well as offline, doing events, going to places where these people congregate, getting in touch with, the women's league in a particular town. So we definitely did a lot of collaboration and kind of brainstorming around where are places where these people congregate and how are we going to best grow this business. So I think that relationship part is really key. And I think in one instance, which is the company we have not yet invested in, and we probably won't, but One of the issues they had, and again, this is more on the social side. So this is a company that is based in Hudson Valley of New York, and they're very focused on the local food movement in that region, and they're kind of a provider of services to a lot of local farmers. They actually had a foundation, a New York-based foundation, issue them a convertible note. I can't remember how many years back. And so I think most investors, the way convertible notes are typically used is exactly what Payal just described, in that there's sort of an expectation of further investment down the road. In many of the cases, there is, if the company reaches maturity, there is a provision where that can get converted to an amortizing loan. So this foundation, and granted, this is a foundation, it's using PRI money. This is not, a personal, an angel investor's personal funds. The foundation wanted to convert it to, they didn't want to convert to equity. They actually wanted to start receiving amortizing loan payments. And that just put a tremendous burden on this company who still needed to raise money. Now they've got this big piece of amortizing debt, and they're trying to raise equity over here, and it just was a very untenable situation. Eventually, what the company ended up doing is they negotiated with that foundation to agree to subordinate to any incoming investors, which now puts that company in a better position to go out and raise particularly debt financing. But it was a very strained relationship, and it took several months of negotiating to get to that point where the foundation agreed to that. So that's just kind of I guess that's a cautionary tale of when you don't have really clear expectations up front of what the investor and what the entrepreneur need, things can just get a bit kind of sticky and down the road.
And to your question around a bad relationship and what that looks like, so I won't name the company, but we had a founder in our portfolio who felt that he had to achieve certain revenue targets. I mean, even though we had all agreed on kind of what the revenue targets were, and was doing two things that are death traps. One was kind of hiding or curating information for the board, which was having certain people come in and present in the board meeting, and no one else knew what else was in the board meeting in his management team, and so was curating the information. And then two was doing something that was kind of borderline fraudulent in order to increase their revenue, so that he could meet what was in his head a revenue target that we were not even pushing or in any ways emphasizing to him. And so that's a really unfortunate kind of relationship, because this was a company that's already grown 100% year over year. You have a fantastic team. People love to work there. You're crushing it on all metrics. But for whatever reason, the psyche of this founder, and what does happen with a lot of founders, is you're driven, right? This is why you started a company. You're kind of type A. You want to succeed. You want it to be the best company ever. And so sometimes that border between being a go-getter and being on the wrong side of that can be challenging for some entrepreneurs, and that's just when we don't get information or you're doing something fraudulent, that is not going to turn out well for you. And in this case, I mean, we were able to successfully exit him from the company in a way that didn't kind of ruin his career, but then we did bring on a CEO, and so that's an example of when things don't go so great.
Thank you. So I hope you've been catching some of the themes here about really understanding alignment of interests and expectations, and about forming a relationship and the amount of time and effort it takes to do that. And not only that, but the transparency that you'll have to practice with investors. So if you feel at all uncomfortable about any of those things, then probably having an outside investor is not going to be a great fit for you if you're somebody who really, really feels the need to control things very tightly, or if you really don't like the idea of having someone, even very helpful, be really in your company with you. And not only that, but if you don't foresee wanting to hand over a significant portion of the company or to sell it, if you want to remain private, if you want to hold it, you may not really want to consider going down that path. So, Julia, back to you. Let's talk about some of the other forms of capital that founders might think about, ranging from bootstrapping to contracts and other forms. Can you give us just kind of a quick survey of what those really look like and what each one really offers in terms of its ideal use?
Right. Okay, so there's so many different forms of funding these days, but I would say they fall into a few major categories. We've already heard a little bit about some of them. I'm going to go through these different instruments and different sources and just give you like maybe the top couple benefits of each and maybe the top drawback, if that's fair. First of all, with angel investment, I guess it's a common source. Well, it's difficult to get. In fact, most angel investors, these are sophisticated, accredited investors that are usually very knowledgeable in the space that they're investing in. So these really are going to be experts. They may have even been professional investors at some point. And so they're going to be very interested in a high growth company that has a potential, as Payal said, to have a very large market, such that they could get a very large return on their investment. So they're going to negotiate very competitive terms. It's very difficult to get, and they know that. So they are really, I call it the golden rule. It's the guy with the gold makes the rule. So those are going to be tough terms. But that said, that is at the early seed round, at the seed stage, where it's really difficult if you can't bootstrap, it's really difficult to grow without that money. So you just have to balance how how comfortable you're going to be as the management with terms that could give that angel a significant portion of your company at some point. The next category I would call probably the venture capital firms. Again, very difficult to get that capital. In fact, I looked at the statistics the other day, and it was like 95% of the VC money goes to entrepreneurs based in like 3 states. And I think that's California, Massachusetts, and was it New York? New York, that's what I thought. So so if you live in the middle of Iowa, you're going to be one of, it's unlikely you're going to get funded. And that's just, the geographic reality. So very difficult to get, very difficult terms, and the upside is having the support of a VC firm can avail you to a lot of resources and mentorship, and so you have to, if you are in experienced management, it's probably going to be a big benefit to have somebody like Payal to call if you run into challenges. And so they can really be, the right VC firm can be a growth partner for you. So moving on, something like crowdfunding. The benefit of that is that you're going to get great terms, right? You can decide it's very flexible. It doesn't have to be in the form of a convertible note. The SEC has not mandated any particular type of a securities instrument. In fact, you can even give what's called the SAFE that we'd mentioned earlier, the simple agreement for future equity. That's not a debt instrument. It's not an equity. You've issued no securities. There's no fiduciary duties that you owe to shareholders at this point. All you've done is enter into a contract to issue stock at a future time. So it's unlikely to really impede your future funding sources. So that's why a lot of the companies are going with those. They've actually improved that model a couple times since these smart lawyers out in the Silicon Valley came up with that. They're calling it a KISS. It's keep it simple, safe. Yeah, so sounds nice, right? But there are some issues with that. The KISS instruments actually, a lot of times they add a valuation cap, or you can choose either the valuation cap, the investor can choose, or a discount conversion rate. So there's some couple extra goodies in there. So that's the good thing about the equity crowdfunding is, it can be really great terms for the company. Here's the bad thing, guys. It takes time. Generally, the preparing the disclosures, the marketing, where you don't spend money on lawyers and accountants and auditors, you're going to spend it on professional marketing. And no, I don't mean your friends on Facebook. This is going to be really require. Like nobody gets up and says, you know what, I'm going to get some coffee this morning and I'm going to go and see what crowdfunding offerings are online and get my credit card out. Nobody does that. So this is going to require a lot of professional marketing from the folks who really know how to do this. They're going to target the thought leaders in the industry. They're going to target, you may need some celebrity endorsers. They're going to, target the financial industry. So you really need the support of a lot of folks when you're doing a crowdfund offering. And the other drawback is that, again, the expenses it takes time and the expenses of actually hiring marketers to do that. Other funding sources, there's other ways you can do public transactions that aren't your typical IPO. You can do some what we call a reverse merger. There's unfortunately that's led in many times that I've seen in some disappointing results long term. I think there's some issues with maintaining shareholder value with those kinds of transactions, but you will encounter folks if you have a company that's cash flowing, and again, misalignment between the investor expectations and the company. They want a fast exit. They may suggest, putting it in your deal into a public shell. The problem is everyone's shares become unrestricted after 6 months or a year, and all of a sudden, your share prices plummet because your company is just not ready to be public yet. So there's a lot of funding options, but you just have to weigh the potential risks and benefits. It's going to be different for every company.
And I'll just mention a few others that sometimes aren't thought about. One being kind of venture debt, which often does come alongside venture capital investment, but you could go to the likes of Silicon Valley banks or the Square One banks, and there's a whole set of banks who do take really early stage risk on startup companies, and depending on the profile of the entrepreneur and the company, they're willing to give you a loan, which could be a great option. The second, there is a lot of kind of accounts receivable financing. If you have that type of business, you can get that, which in accounts receivable is all right. You sold product, you're just waiting for customers to pay you, and people will finance you on the basis of a certain percentage of what you're expecting. And the last and best financing is customer financing, which is your customers are essentially funding your business. So let's say you have a SaaS product, you charge monthly, but you have a 1-year contract, so 12 months, and customers often you can get them to pay up front, and so you got 12 months of product payment in the first month, and so that helps with what's called your working capital, and in some cases, if that scale is big enough, you can kind of finance yourself on the basis of customers, and that's often something that bootstrap companies really try to optimize.
Thank you. So we're going to get to questions in just a second. The last thing I want to really ask the four of you to comment on is as you contemplate the current atmosphere, right? Like we have a lot of activity here in the Boston area. As you mentioned, Julia, Boston, Massachusetts is one of the states that has actually the lion's share of funding activity, not just venture. But as you look at the current state of affairs, what do you see as the current trends? Do you see, for example, do you see a shift towards other funding sources like crowdfunding? Do you see more entrepreneurs bootstrapping for longer before they seek outside funding? Do you see more collaborative interaction across different kinds of outside investors, as you mentioned, Payal? What do you see as, from your point of view, the current trends that founders should be aware of just to understand what's happening around them?
So I note that there's really interest in crowdfunding. It's not really a fair statement to say that there's a lot of equity crowdfunding going on. There's really not. It's really in its infancy. So just to be clear, I think that we've only had about 150 companies since last May actually successfully do a crowdfund offering. That said, I think I've seen it used not so much as the end goal, because let's be honest, most companies need more than $1 million. They're serial issuers of securities, and so they're going to go through several rounds. But it can be helpful. It seems that the trend is that it's a good way to test the market, so to speak, for whatever your product is or your service, and just see how, what the market perception is, and how, and a lot of professional investors are also looking to see if there's, a positive response to your product, among unaccredited investors. And so it can be sort of a red flag. If your friends, family, and customers didn't invest in the crowdfund round, I mean, is this really going to be, the next big thing, right? So I've seen it kind of used, a tool like that, just to sort of test the waters, so to speak.
Anybody else? Payal?
Sure. So I'll mention a few statistics first that kind of help with the foundation of my answer. So, and we've talked about this a little bit, but in 2015, there was about $6.6 billion of venture capital invested in Massachusetts, which was third after California area and New York. We were kind of neck and neck with New York. The important piece of that statistic is that $4.5 billion of it was what I would call imported, was invested by funds that are actually not based here in Massachusetts. So the 2.1 came from folks like us, but $4.5 billion came from folks largely from California. And that's been growing over time, so I think that's a really positive sign for the Massachusetts ecosystem. It's a great place to start companies. We've always had the talent. We are now having more people stay here after they graduate. So about 10 years ago, 60% of graduates from schools and universities here in Massachusetts would leave. Today, it's the opposite. 60% will stay. So I just think that those statistics show a positive trend for Massachusetts. The second statistic or macro trend I'll highlight is that if you look at the last, I think we only have data right now for, call it the first 3 quarters, or the last 3 quarters or so in 2015, but valuations were steadily increasing, and the size of the rounds that people were raising were steadily increasing. And so we're getting back a little bit to what may be, I wouldn't call it a bubble, but just there's been a lot of excitement, there's been a lot of investment, but on the other side of that, right, the exit side of it, we haven't seen the IPO market open up. The one company that was supposed to go public and open up the tech markets this year, AppDynamics, was acquired instead of right the day before they were supposed to go public, and this was last week. And so I do think you're going to see a little bit of temperament from the VC industry just because of these dynamics. We will continue to fund as usual, but we are having to think about what is the exit path for our companies. And the good news about Massachusetts, unlike I think the Bay Area, is that we've been consistently what I would call as prudent. We've always looked for fundamentals in companies. The trade-off is the valuations tend to be a little lower. And because of that discipline, we haven't been affected as much by the ebbs and flows around the broader economy. But in the Valley, right, you're seeing whole sets of companies just being wiped out in the food delivery space or whatever because people funded 10 of those companies and there's only room in the market for two or three of them. And mind you, these companies are valued at like hundreds of millions of dollars. So in general, I feel positive about the funding environment in Massachusetts. It's going to just continue to be hard. And so the last stat I'll mention is just our funnel. So we see probably 800 or so companies a year pitch to us for funding as a firm, and we are not a large fund. We're a $220 million third fund, so the larger funds are presumably seeing even more. We will spend time in diligence with about 80 of them really intensely, and then we'll invest in about 8 per year. So that's a really kind of broad stroke. So you're seeing kind of our funnel and how hard it is to get funding from the VCs.
I just want to actually talk about something that you mentioned, Addie, in terms of, in addition to Massachusetts being a hub for venture capital, it's also increasingly a hub for this kind of more social capital that's getting put to work, whether that be from foundations or increasingly individuals. So if, and what's interesting is a number of you have said that, you're thinking about starting businesses that were not necessarily purely for profit, that they were either nonprofit or maybe some sort of hybrid. And so I think in that sense, there are actually a lot more opportunities for those companies than there were, I'm sure, 10 years ago.
Even 3.
Or even 3. What's challenging, so it's great that there's an increased number of options, but the challenge is that it's not as established as kind of the model that Payal's been working with. So where I think you have very clear expectations of, okay, we're going to funnel this down. These are our companies, and this is how we're going to support them going forward. That kind of isn't all fleshed out yet, I don't think, in the more mission-oriented investing realm. So just a word of caution that while there is more money going into the space, I think that the dynamics in terms of how things are going to how investors are going to behave, how businesses are going to evolve going forward hasn't really been fleshed out yet. So it's kind of still in flux, I think.
I would agree with that, and I would add, I think, for example, Echoing Green is a fellowship program that provides capital and mentorship services it used to be mostly for nonprofits, and they have expanded to include hybrid and B Corp organizations, and the number of organizations that fall into that category has skyrocketed. And I think it's actually for 2 reasons. One, I think a lot of nonprofits, what might have been a nonprofit before, people are starting to think, hey, I can actually do this, and have a fiscal component to it. And on the other side, I think ideas and services that people thought might have been purely, for fiscal gain before, they could actually move into that center space and play there as well. So I think it's something like, 3 of their fellows in a given year were in this hybrid space, and then last year it was like 50 of them. I mean, it's just astronomical. So there's a lot of great resources out there for those who are considering that middle ground or purely a nonprofit model, like Echoing Green, like Ashoka, like Acumen. I think it's incredibly inspiring and to me to see organizations like Bain Capital start under the former governor of Massachusetts, Deval Patrick, to start a section of their work, which they are looking at investments that they can make for market rate return that have a social component to them. And so to me, that's like a big, huge indicator of where the market is going. You have, the Harvard Business School. The largest club at the business school now is the Social Enterprise Club. And so you see this huge shift of what people are interested in, and those people also become, consumers. So it really matters now to millennials. I feel like I'm talking to the millennials here anyways. You guys care that this stuff meet certain criteria. And so I think the market is following that very quickly. I see a lot of products now that I didn't see a year ago that have the B Corp thing on their packaging. And I didn't see that a year ago, and I see it all the time now. So I have a lot of, rah-rah in me for exploring that kind of funding and model.
Cool. Really quickly, Julia, so we can turn it over for audience questions.
And Julianne, we have about 10 minutes.
Yeah.
Oh yeah. Okay. So yeah, I would echo that observation. I mean, one of the largest, by far, the portal that has had the most successful crowdfund offerings. Actually, the founders, I think, came from this great institution here called WeFunder. And WeFunder actually surprised everybody in December and actually declared it was transitioning to be a B Corp as well. So there's definitely that interest. And a lot of, even in equity crowdfunding, you see a lot of the successful offerings have some sort of a social component to it. So whether it's women founders or they're working for, they're increasing economic opportunities in communities that have been in the past underserved by other financing, and so a lot of great things happening.
Thank you. All right, questions?
Okay, so but I'm intrigued about the that whole customer financing piece, because I think that could work for the model for my company. I own a gym up in New Hampshire right now, and actually I didn't even realize it, but we had to take out a bond for anybody that prepaid over 60 days, and it was quite cumbersome in terms of reporting, and the size of the bond actually scaled with not just prepaid customers, but total customers, and so it just became not worth it. Are you aware though, I mean, could that just be one small thing for like the health and fitness industry because of the amount of churn we had and everything? But are you guys aware of any legal issues in doing that, like more on a traditional type of model?
Okay, so for the sake of anybody who couldn't hear, and as Joe pointed out, for the sake of the recording, I'll just summarize that succinctly. Are you aware of either legal or other constraints on customer financing that extend across segments or across industries, or specific ones by industry, for example, in the health and fitness?
Yeah, I'll just briefly comment, and I can talk to you after the break and look this up for you. I'd be happy to do that. But as I understand, and I'm licensed here in Massachusetts, and so I'm not that familiar with the New Hampshire statutes. But my gut feeling is that anytime in Massachusetts, anytime you're collecting any sort of customer deposits or any sort of funds in advance. I know in Massachusetts, for example, everybody probably, those of us who rent here in the area, you know that your landlord has to put your deposit in actually an interest-bearing account. And so if you're holding customer funds, if they prepaid in advance, I'm imagining that you're having to get some sort of a surety bond for those funds. Yeah, there's those regulations are governed by states, so it really varies state to state. And my feeling is that it's not limited to the health and fitness industry. It's probably any time you're holding customer funds.
Other questions? Yes?
Could you say a bit about some of the common mistakes to avoid when raising money from friends, family, and angel investors?
Okay, so what not to do when you're raising friends and family capital?
So one is to be very careful when raising money from personal contacts and making sure that it's clear that their investment can go to zero. And I think often people don't have that understanding. They're giving you personal money, and if it's any decent portion of their net worth, I think you want to be upfront with them and say, I'm all in this, I'm going to try my best, but just like any other startup, there's a chance that this doesn't work. So often I would say some friends and family get duped. Aunt Betty gets duped and others, and that just creates a terrible personal relationship, and I've seen that happen sometimes. But otherwise, I do think the tactical thing to watch out for is just how you structure it. So you cannot just take money, 10 grand from your family and then just spend it. I mean, you still have to set up all the legal infrastructure around your company. You have to set up what their funds are investing into. You have to give them an actual, there's paperwork that's exchanged. And so making sure that all of those terms are clear and that all of those terms are set so that you don't shoot yourself in the foot for the next round of funding. So getting great legal advice on how to structure that is important.
And I would just add to that, make sure you have a really candid conversation with them about all the ways you could lose their money. And make sure that they can afford that. Because it's entirely possible, particularly with friends and family, that somebody may give you money that they really can't afford to lose, and you want to make sure that you don't make that mistake. A good friend likes to always have that conversation to say, listen, if all this goes south and I lose all of your money, are we still friends? And that's a really good thing to understand, right? Anybody else? Other questions? Yes, ma'am.
So I've been working on my startup for about a year, and we finally got a term sheet from VC last month. But we decided that because they're asking like 20% of equity after calculating the cap, so we decided not to take the term and bootstrap a little bit longer. But now I've heard how difficult it is to get raising money. But so my point is, we heard that matter whether you have over 50% control as a founder, as long as you introduce institutional money, basically you kind of lose control because you have to be responsible for the capital providers. So is that true? Also, generally speaking, while you still can bootstrap, is it a better idea to take the venture money later when you have better valuation?
Okay, so first of all, is it a better idea to take venture capital than to pass it up if you don't like the terms? Second, how do I think about control? How do I understand what control I retain and what control I give up if I bring in outside investors? And third, is it better to wait and take investors later?
Right. So on the ownership piece, well, first of all, congrats on getting to a term sheet. Like you now realize that's a great accomplishment, and so congrats on that. So 20% ownership sounds pretty standard. I mean, we take around 25% ownership of our companies, and so I do think that is the realm that you're getting into. But what's really important to understand is that, and when I think about whether that amount of ownership, it may be hard to swallow, but you have to consider, can you get where you want to go without that money and without that help and without those resources, or can you not? And so one of my colleagues often says, like, do you want to be king or do you want to be rich, right? And you kind of have to decide. That's the trade-off you want to figure out. Is the venture capital money going to help you really get there? If so, giving up 20%, if you do the math, may not be the end of the world. The second thing is, it is really about control. It's not about ownership. So even though we own 25% of a company, which is a minority ownership, right? Anything below, 51 is minority. We have legal and contractual control in many cases, right? Control is dictated by the legal documents, how the board is composed, and what items have to be voted on by the board. Does it have to be voted by majority or is our vote, in certain cases, our vote is required in order to do, certain things like fire management, hire management, take on any additional investment, things like that. So there's a whole lot of legal things that give us control, and the reason for that is, often people say, oh, you terrible VCs, you kind of take all the control, but the reality is that our fiduciary duty is to the people who give us money. So our funds, and we talked about this early on, but our money is taken by traditional LPs. It's state and local governments, it's pension funds. Our LPs include the California State Teachers Pension Fund, Texas Teachers, the state of Maryland. If we don't make a return on our fund, and if we don't protect capital, those people aren't getting the allocation of their pension that came from asset classes like us. So we have a fiduciary duty to protect our capital, and that's why things are structured the way they are structured.
All right, anybody want to make a last comment quickly, because we're out of time, about whether it's better to bootstrap longer and wait to take on outside investors after you've gotten further down the road?
The only thing I'll add to that is that, you really that depends on your industry. If you know that you need to get market share quickly, you really, and you don't have the internal resources to get there, your competitors are going to be they're, as the video described, they're in the race with you. So you don't want to not say, I need this big piece of the pie here, and I don't want to take any outside money if what's at the end of the day, you're going to have a really big piece of a pie that doesn't have any, it's not worth anything. It's better to have, and this is sort of the general concept, better to have a smaller piece of the pie and actually reach your goal, as I think Payal described very well.
All right, so we are out of time.
Can I just say
Yes.
one super important thing?
Really quick.
Super quick. If you're interested in nonprofit or the hybrid model, foundations are harder money, but they have a lot of resources that they can provide you. High net worth individuals are a lot easier to get. And then thanks to rumblings from Trump, there could be a huge influx of philanthropic money in 2017 because he might change the tax regulations around what you can contribute. So people far smarter than I are saying, what is coming? So there could be a huge amount of money coming out this year for charitable purposes.
All right, so stay tuned. Thank you all very much for your attention. Please join me in thanking our illustrious panel.
And Julianne, Julianne, that was a fantastic panel, and now that we've videotaped you, we actually have to get a release form. You can read it for the panel. We're going to take about a 5-minute break today because we have a lot of content, and people who said they'd like to pitch, we'll put you up tomorrow, if that's all right, when Ronald's here, but we've got a compressed schedule. So thank you very much, panel. Thank you.